So let's kind of revisit this whole concept of separately stated items. We talked about ordinary income pretty much in the last section, but we've got these separately stated items for all of those, like because it's a flow-through entity, all of these different types of income and expenses are treated differently on a per partner basis. We have to list them separately on the tax return on the 1065, and then we also have to list them separately on the form that gets distributed to the partners so that they can properly account for them on their own individual tax returns. So every income or expense item of a partnership that may be treated differently at the partner level must be separately stated. So that Schedule K, as I pointed out on the 1065, lists all the separately stated items, and then those amounts on that Schedule K are listed on each K1 based on the partner's ownership percentage. So these allocations to partners. So each year, each partner in a partnership has to receive the Schedule K1, reports the partner's share of ordinary income or loss. Section J of the K1 shows the partner's percentage share of profit, loss, and ownership. So the items on the K1 correspond directly to the items on the Schedule K. So the Schedule K is essentially a summary of all of the K1s. So I'll show you. So this, as you recall, I think we've looked at these. I don't know if we looked at one before. I can't remember if we saw one on Chapter 8 or not. But so our ordinary business or income is here. So all of those items are net income minus all of our deductible expenses from the ordinary course of business in the percentage of ownership for this partner. So this partner owns 40% of this business, which means that 40%, this is 40% of the amount of the ordinary income for the whole partnership, right? So you could figure out, from this, you could figure out what the partnership earned, right? So every partner could figure out what the total is that partnership earned, because if they can do the math, they can do this. Now, this partner also received $42,000 of guaranteed payments. So this partner is going to pay self-employment tax on this amount and this amount. So $102,450 is what they should be paying self-employment tax on. Now, this partner also had their share of the ordinary dividends that the partnership earned and qualified dividends listed there. Short-term capital gains, long-term capital gains. I think this is the $2,600 is a charitable contribution, I do believe. Or maybe it's not a deduction though. I don't know what the code A is. So each of these has like a code, and that code, like if you were to flip the K1 over, it shows a list of what the codes mean for each of the boxes. They had a Section 1231 gain. They also received a distribution of $26,000. So from their basis, their ownership of the partnership, they got a payment of $26,000. Now, chances are that payment was to help pay the taxes on these amounts, to help them to pay those taxes, the $26,000. Oftentimes, that is what happens on these partnerships. Is you may not get a whole lot of cash out of it, but hopefully you're getting enough cash to pay the taxes that you're going to owe on the partnership. Because all of these things, if there was no distribution, this partner is just going to have to come up with the taxes to pay on this income. And if they didn't get any cash out of it, they're going to have to come up with that money somehow to pay those taxes. But a lot of times, like I said, what happens is the partnership will give them a distribution, and that amount is then intended to help them pay those taxes. Over here is essentially this is like their basis over here. So their starting capital account or basis $116,900. Then, and this feeds into how our basis is adjusted based on events that occur throughout the life of the partnership. So you can see current year net income adds to the basis. Withdrawals, distributions, reduces the basis to get to our ending basis. Now you see, guaranteed payments are not listed in here. They're not included in here because, remember, basis is based on have you paid tax on it or not. So yes, it was a deduction to the partnership, but they're paying tax on this. They're going to pay tax on this. So that's why it's kind of an in and out for the partner. So that's why it does not affect. So that's why this current year income or loss does not, the guaranteed payments are not included in that. That would include everything else, but not the guaranteed payments. Let's see here. So here's an example. We've got Knox as a partner in Knox Smith & Wood partnership. He owned 33.3% from January 1st to March 31st. So this is when we've got a partner that exits during the year or enters during the year. Their partnership, what shows up on their K1, is going to be apportioned for the amount of the year that they actually had ownership. So in this case, is this the same? No, this is not. So this company had ordinary income of $76,000, capital gain of $8,000. So Knox, because he only owned it for 1/3 of the year, is that right? Partnership had $78,000. He owned 66. Oh, okay. He owned 33. Oh, this is where his ownership percentage changed during the year. Sorry. So he owned 1/3 of it for the first couple of months, and then he must have bought out one of the other partners, and now he owns 2/3 of that partnership, and so his ownership percentage changed. So it's going to be apportioned based on the portion of the year that he owned that percentage. So the $76,000, he owned 1/3 of it for the first 3 months of the year, but he owned 2/3 of it for the last 9 months of the year. So that income is going to be divvied up in that manner. I kind of already talked about the self-employment income, the fact that the ordinary income is considered to be self-employment income, but guaranteed payments are also considered to be self-employment income, but then you get to deduct the 179 expense from that, because remember that 179, the only reason it's separately stated is because it's each partner has their own limits that they have to meet on that 179. Otherwise, if that wasn't the case, then that would be included up here under ordinary income, but it's not, because it's, like I said, some partners may get it, some partners may not get it, but that will affect as well the self-employment income portion. Qualified business income deduction. Income from the partnership qualifies for the QBI deduction. So same thing that we did in Chapter 6 with that QBI also applies. So if you need any refreshers, you can go back to Chapter 6 and remind yourself what that QBI is and how that is calculated in there. All right.